I spent 3 weeks analyzing 26 years of market data to answer one question. Does sell in May and go away actually work? The answer cost me a belief I held for 4 years. See, I used to follow this rule. Every April, I'd start scaling out of positions. By May 1st, I was mostly cash, and every November, I'd buy back in. For 4 years, I thought I was being smart. I thought I was following time-tested wisdom from Wall Street's greatest minds. But I never actually checked if the wisdom was true. I just trusted the headline. And that laziness, that's what this video is about to fix. For me and for you. Let's start with where this even comes from. The phrase sell in May and go away originated in the British financial district. The full version is actually sell in May and go away, come back on St. Leger's Day, which is a horse race in September. The American version comes from Yale Hirsch's Stock Trader's Almanac, first published in 1964. The theory is simple. Markets historically underperform from May through October compared to November through April. Therefore, you should exit in May, sit on cash for 6 months, and re-enter in November when the good season starts. And to be fair, when Hirsch published this in 1964, the data supported it. Markets from the 1950s through early 1960s genuinely showed weaker summer returns. But here's the problem nobody talks about. That data is now 60+ years old. Markets have fundamentally changed. Algorithmic trading didn't exist. Retail traders didn't exist at scale. The internet didn't exist. Global capital flows were a fraction of what they are today. Therefore, the question isn't, was this true in 1964? The question is this true now? And that's exactly what I tested. Here's how I structured the test. I pulled data from January 2000 through December 2025 to 26 full years. I tested 4 assets: S&P 500, the benchmark that the original sell-in-May strategy was designed for; NASDAQ 100, the tech-heavy index that dominates modern markets; gold, because it's become the go-to hedge and one of the most actively traded assets; and EUR/USD, because forex traders need to know if this applies to currencies too. For each asset, I compared 2 strategies. Strategy A, sell in May, sell May 1st, buy back November 1st, sit on cash for 6 months. Strategy B, stay in the game, hold through the entire year with no seasonal adjustment, no cherry picking, no optimizing start dates, no adjusting for, well, if you exclude 2008, because real traders can't exclude 2008. They lived through it. Same rules every year for 26 years. Let's see what happened. Asset 1, S&P 500. Let's start with what sell in May believers expect. May through October should be consistently negative or at least significantly worse than November through April. Here's every May through October return since 2000. Year 2000 minus 4.2%. Okay, point for the sellers, 2001 minus 19.8%. Brutal, but that was 9/11 and the dot-com crash, not a seasonal pattern. 2002 minus 16.1%. Again, bear market, not a season. But then watch what happens. 2003 plus 12.7%. 2004 plus 1.3%. 2005 plus 4.2%. 2006 plus 7.1%. 2007 plus 6.8%. 5 positive years in a row. 2008 minus 28.6%. The financial crisis, obviously. But nobody was saved by sell in May in 2008 because the crash started in September and didn't bottom until March 2009. The May sellers who bought back in November, they bought before the bottom and lost another 25%. Therefore, the 1 year where sell in May should have been a hero, it actually made things worse. Let me speed through the rest. 2009 through 2019, 11 years. May through October was positive in 9 of them, including 2013 at plus 10.0%, 2017 at plus 8.3%, and 2019 at plus 7.1%. 2020, despite COVID crashing markets in March, May through October returned plus 19.7%, 2021 plus 10.3%, 2022 minus 5.8%, the Fed rate hike year, 2023 plus 3.2%, 2024 plus 11.4%, 2025 plus 6.8%. Final count for the S&P 500 Out of 26 years, May through October was positive in 18 of them. That's a 69% positive rate. The sell in May strategy would have had you sitting in cash during profitable months almost 7 times out of 10. But here's the real damage. If you invested $10,000 in the S&P 500 on January 1st, 2000 and just held, never selling in May, never timing seasons, you'd have approximately $64,000 by December 2025. If you followed sell in May religiously every single year, selling May 1st, buying November 1st, you'd have approximately $31,000, $33,000 in missed gains on a $10,000 starting investment. That's the price of following advice from 1964. Asset 2. NASDAQ 100. The results are even more extreme for tech. May through October was positive in 19 out of 26 years, a 73% rate. The NASDAQ's biggest summer gains include 2003 plus 25.4%, 2009 plus 34.1%, and 2020 plus 32.8%. Sitting out those summers would have been catastrophic for any portfolio. The stay-in-the-game investor finished with $107,000 from a $10,000 start. The sell-in-May investor, $42,000, a $65,000 gap. NASDAQ punishes seasonal sellers harder than any other major index. Therefore, if you trade tech or indices, sell in May isn't just wrong. It's portfolio destruction. Asset 3, gold, XAUUSD. Gold is interesting because it has different seasonal patterns. May through October was positive in 16 out of 26 years, 62%. Not as strong as equities, but still majority positive. Gold's weakest period is actually March to April, not May to October. But here's the key finding. Gold's biggest moves of the decade, 2011's bull run, 2020's COVID spike, 2024's record highs, all had significant portions during the sell months. If you sold gold in May 2024, you missed a $300 per ounce rally from May through September. On a one-lot position on MagnoFX, that's $30,000 in missed profit. Asset 4, euro to US dollar. This is where sell in May completely falls apart. Forex has zero seasonal pattern. Zero. I tested every major pair. EUR/USD, GBP/USD, USD/JPY, AUD/USD. The win rate from May to October direction was between 46% and 54% across all pairs. Statistically random, there is no seasonal edge in Forex. Therefore, if you're a Forex trader who's been hesitating to trade in summer because of sell in May, you've been applying stock market advice to a market it doesn't even theoretically apply to. So if the data is this clear, why does sell in May persist? 3 reasons. Reason 1, confirmation bias. Traders remember the years it worked and forget the years it didn't. 2022 was negative May through October. People said, see, sell in May works, but they forgot about the previous 4 positive summers. Our brains are wired to find patterns, even when the pattern is noise. Reason 2, media incentive. Sell in May is the perfect clickbait headline. It's catchy, it's seasonal, it fills content calendars. Every financial publication runs this story every April because it generates clicks. Therefore, the strategy persists, not because it works, but because it drives traffic. Reason 3, the cost of being wrong is invisible. When you sell in May and markets go up, you don't see a red P&L. You just miss the green. And missing gains feels less painful than taking losses. Behavioral economists call this regret aversion. You'd rather be wrong by inaction than wrong by action. But here's the truth. Those psychology tricks are hiding. Over 26 years, the invisible cost of missed gains was $33,000 on the S&P, $65,000 on the NASDAQ. That's not invisible, that's a house deposit, a car, 3 years of rent. It's real money that the sell in May strategy silently stole from your future. Therefore, let me give you what actually works instead of a seasonal meme. Rule 1, time in the market beats timing the market. This isn't just a cliche. The data from this entire video proves it. Across 26 years, 4 asset classes, and every possible economic condition, staying invested beats seasonal timing every single time. Rule 2, trade the chart, not the calendar. If your strategy gives you a buy signal in June, take it. If your setup triggers in August, take it. The month is irrelevant. Your edge doesn't expire with the seasons. Rule 3, reduce risk during uncertainty, Don't eliminate exposure. If summer volatility worries you, lower your position size from 2% to 1%. That's risk management. Selling everything and sitting in cash for 6 months isn't risk management, it's fear with a fancy name. Rule 4, use the right infrastructure. The traders who thrive in every season, May through December, January through April, are the ones whose broker doesn't add friction. Wide spreads eat your edge in low volatility summer months. Slow withdrawals trap your capital when you need flexibility. Platform freezes during thin markets destroy your confidence. I trade on MagnoFX year-round. Zero spreads mean my edge is the same in June as it is in January. Same-day withdrawals mean I'm never trapped. 500 to 1 leverage means a summer position is just as capital efficient as a winter one. The platform doesn't care what month it is. Neither should you. Let me put the full picture on screen. S&P 500, 18 out of 26 summers positive. $33,000 lost to sell in May. NASDAQ, 19 out of 26 summers positive, $65,000 lost. Gold, 16 out of 26 summers positive. Major rallies missed. EUR/USD, zero seasonal pattern. The advice never applied. 26 years of data. 4 major asset classes. 1 conclusion. Sell in May and go away is a strategy for people who'd rather be comfortably wrong than uncomfortably profitable. The traders who build real wealth don't follow seasonal slogans. They follow their system. They manage their risk. They stay in the game. Every month, every season, every year. Stay in the game. Link in the description to trade with MagnoFX. Zero spreads, same-day withdrawals, 500 to 1 leverage. The platform for traders who show up year-round. If this saved you from sitting on cash this summer, drop a like and subscribe. Because next week, I'm breaking down the 5 trading psychology mistakes that blow accounts, just in time for Mental Health Awareness Month. See you there.